the Task Force 5. So I acknowledge that under the Task Force 5, we are organizing the series of webinars which you have noticed in the last 2 weeks and today. Today's session is being chaired by Dr. Arvind Virmani, who's a member of Niti Aayog. He was also the chairman of our foundation as well as president of the Forum for Strategic Initiatives. He's been a mentor to FICCI and a member of RBI Technical Advisory Committee on Monetary Policy. He was earlier the chief economic advisor of our country. He was the executive director at the International Monetary Fund, published extensively. Earlier, he had worked at the World Bank and then at the Planning Commission. So with this brief introduction, I would now like to move on to introducing our speakers and then inviting them to speak. Our first speaker for the day is Professor Avinash Persaud, Special Envoy to the Prime Minister of Barbados for Investment and Financial Services. Avinash Persaud I have known him for many, many years and had the benefit of his thoughts while I used to work at the Reserve Bank of India. Briefly interacted with him when I was at the IMF. Known him for so many years, I thought the topic that we had today, he will bring in very important dimensions. He is a non-resident senior fellow of the Peterson Institute for International Economics, Washington, emeritus professor of Gresham College in the UK, and non-executive chairman of Elara Capital, an investment bank based in Mumbai. He was ranked one of the leading public intellectuals in the world on the financial crisis by a panel of experts for the UK's Prospect magazine a few years ago. Very, very well known in academic circles, published extensively on finance and economics. He has worked on a number of major policy commissions, and I thought he is appropriate for this session that we have today. Our next speaker for the day will be Mr. Prashant Saran. Again, known him for many years in the Reserve Bank of India. He has been a financial sector regulator for over 3 decades, contributing significantly in the securities market, banking, and foreign investment. He served as a whole-time member of SEBI from 2009 to 2016, where he was deeply involved in issues pertaining to investor education and investor protection. He has been instrumental and responsible in carrying out far-reaching reforms in primary market and mutual funds. We invited him specially for this session because when he was at the Reserve Bank, he was actively involved in Basel norms, and that is where I came to know about, for the first time, the way Basel norms are being constructed and discussed. Our third technical speaker for today is Mr. Anand Sinha. Mr. Anand Sinha was the Deputy Governor of the Reserve Bank of India. He had joined the Reserve Bank in 1976 and rose to the rank of the Deputy Governor in January 2011. He has been with the Reserve Bank for a very long time. And as Deputy Governor, he was in charge of regulation of commercial banks, non-banking financial companies, urban cooperative banks, and therefore we thought he would be the best suited to come and speak to us today. After retirement, he continues to be in the financial sector. He continues to be a consultant at the IMF and deliver talks on financial sector issues in India and abroad. Our last technical speaker for the day is Ms. Neha Kumar. Neha Kumar is a senior research associate at Overseas Development Institute. She heads the India Program for Climate Bonds Initiative and is based in Delhi. She drives policy practice, strategy, and partner programs to scale up the green bonds market and sustainable financial ecosystem. She has worked an extensive experience of about 14 years working on public policy and industry action in India on sustainability and responsible financing. in a stint at GIZ India before she joined ODI. She steered projects that led to a regulation of ESG disclosures by the Indian market regulator.
Yes, sir.
She has also served on national and international standards setting bodies like Bureau of Indian Standards and Global Reporting Initiative, where she vice chaired its stakeholder council. She speaks frequently on sustainability, responsible financing, reporting, and disclosures, and has edited and published journal articles on these topics. She is currently part of a core group of policy advisors and practitioners on future of jobs and green economy. She is an active alumna of Young Global Leaders chosen by the foundation in Germany. So this is the speakers that we have. I would now invite, and we are still waiting for Dr. Arvind Virmani to
I'm
join
here.
us. Oh, sir, you're here?
Yeah.
Okay, excellent.
Thank you,
So
sir.
I have briefly introduced the speakers. I've introduced
Right.
you, and you are chairing the session. Would you like to make some initial observations?
I'm sorry. I want to apologize because I just was giving a talk at IEG, but maybe I'll intervene later, and because I have to just collect my thoughts. So we can start with Professor Persaud. He's left the, and maybe after he's spoken, I can come in and say something.
Sure. Sure.
So,
So
Professor, would you like to start?
Thank you very
Professor
much.
Avinash? Yeah, please.
Well, thank
Go
you
ahead.
very much. And can I just ask whether you can hear me all right? Is
Yes,
it clear?
yes.
Excellent.
Very clear.
Okay.
Very clear.
Well, let me begin by thanking you and the team and Saran and his colleagues to invite me. It's always a great privilege and pleasure for me to speak with you. And it's a very important topic. It's a great prod to us economists because economists believe that
Yes, sir.
the norms and values embedded in our ideas are somehow universal truths that we never really reflect too much on, and we just assume. And so it's good to be thinking about that. And I think that this is of a particular issue around the area of international banking regulation, where there is a sort of intellectual market finance norms, which sort of says that markets are better if there is transparency, if there's standardization, and the more standardization and universality, the better is liquidity, and liquidity is always a good thing, and that is the sort of the norm. And Charan and I first got to know each other when I guess I began questioning some of those ideas, because there was a time when the politicians thought that it would be good to have different types of regulators with different backgrounds. And universality and standardization makes a lot of sense, I think, when you are regulating the railways or the gas industry or the telecoms industry. But it's not automatically clear. It makes sense in the financial industry because, as you have rightly pointed out, diversity matters. Liquidity is actually about diversity. If we all have the exact same opinion and have the exact same valuation model and the exact same risk model, none of us will want to buy or sell anything. And we're happy where we are, and there's no liquidity. Liquidity happens when also people are prepared to lose money in the short term because they've got some long run view of value, which is different than others. And that's why they're prepared to buy something or sell something. So I think that we have to think about where do we want diversity and where do we want standardization. These are not forever universal. And it seems to me that you want a system where diversity reflects some underlying ability to absorb risk. So in any society, there are different people who can absorb risks in different ways. And you want the financial system to amplify that, to support that, not to crush that. And the danger is that if we don't think about this, what our financial regulation will end up doing is crushing that, leading to a homogeneity of institutions, or the homogeneity of views and activities that actually crushes, makes the system very fragile. As we're seeing in the United States today, where a whole set of institutions following a similar kind of approach, because that approach would have been well supported by the valuation models and risk models and all the bank capital models and stress models. 6 months ago, that approach would have been seen as the right approach. And as a result, you had a homogeneity of behavior. So I think that is the key theme I would like to leave you with, which is this idea that there are natural forms of risk absorbing capacity. So, somebody who is young and has an income and can set aside a small amount of savings, and what they're concerned about is what pension they get in 20 years time and 30 years time, has the ability to absorb liquidity risk in a totally different way than somebody who is retired and worried about their health and may have big medical bills to come any minute tomorrow. They have totally different abilities to absorb risk. And we need a financial system that actually identifies and supports that. In a very crude way, life insurers and pension plans should be people who are holding the liquidity risks in our financial system. And banks and mutual funds and casualty insurers who need to remain quite liquid but diversified are the kind of people who should be holding credit risks in our financial system, because the best way to diversify and reduce credit risk is diversity. The best way to reduce liquidity risk is not diversity. Diversifying across a whole range of illiquid assets does not make you liquid. Diversifying across a full range of different credit does make you more credit enhanced. So the danger is that there is this universality norm which is causing us to regulate all of these different types of players in the same way. We're treating casualty insurers as banks. We're treating life insurers as short-dated financial institutions with short-term liabilities. And we need to make sure that we don't do that. Because if we don't have risk absorptive capacity, and the only risk absorptive capacity we have is capital, the system will be very capital intensive, and that may well be negative for growth. So that is, let me end with one final point, which is that at the G20 meeting, a big focus is on how do we get global private savings to invest in climate mitigation in different countries. The developing world needs about $2 trillion of savings, private savings, investing in the energy transition. $2 trillion every year, every year. So the big obstacle is currency risk. If you, it is the international financial institutions say that in order to get capital, we need to reduce risk. And they then shift the onus onto developing countries and say, well, the risk problem is your political risk, it's your fiscal risk, it's your regulatory regime risk, it's your local project risk. But actually, if you look at the numbers, 75% of the difference in the cost of capital of a private project in India versus Germany is made up of the difference in the borrowing cost of the government of India and the government of Germany, which you might call as a macro risk. And given that the government of India's debt to GDP ratio and deficit to GDP ratio are not very far from the European average, the bulk of the difference of that macro risk is a currency risk. And so we need a global institution, and that will use its diversity, use a long-term and patient capital to offer people hedges and currency risk and reduce the cost of capital. There are many risks we can't reduce. There will remain a diversity, which will create an incentive to get better projects and better regimes of regulation, but we can reduce currency risk. And that will help to drive global savings into these developing country markets. So there's a role for standardization and diversification, and there's a role for diversity in maintaining liquidity. Thank you very much indeed.
Thank you, Professor. So before I kind of call the Saran, I think is next line. Coming in the middle. We had the global financial crisis, and I was lucky to get there to the IMF. Hello, you can hear me, Sharon?
Yes.
Yeah. I was lucky that for two reasons. One, I got there immediately after the global financial crisis, and second, I was probably the only economist on the board of directors. Let me just mention two elements which really I thought we had learned. I mean, there were tons of papers by people more qualified than me, which we saw in the IMF. But to put it in a kind of simple, sorry, I should have started by saying, Professor, I really like your concept of diversity. I think there's interesting possibilities there. I should have said that in the beginning. Anyway, so there were basically two, the two issues which kind of were there, which was couldn't be resolved very well. One is the whole issue of contagion, and the second was lender of last resort. I think all the economics I have learned and practiced in India really says that there is no, there's nothing, if you don't have these two, then you can't break that cycle of the crisis or domestic. So what is contagion? I think the part which economists is actually psychology, right? And we don't give enough attention to psychology at all. Contagion is not just economic. Of course, there's but the psychological part, I think, needs much more study and research. And part of the problem, I mean, we all know the moral has an issue. It was made a big deal of, but we also know that whenever it's come to the crunch, the lender of last resort does act and will act. I mean, there's just shutting our eyes to that issue that doesn't solve anything. So the problem which has come back in a sense is that the difficulty we had, I still remember the discussions, is how to define a systemically important institution. Now, I don't think there's any perfect answer, but the history of what has happened in the US does provide a kind of alert to it. If I understood correctly, the Dodd-Frank bill defined it as 250 billion of assets, and sorry, as 50, what was it, 25 billion or something of that order. And 7 years ago, under the Trump administration and the Congress, it was raised to 250. So SVB, which had 213 billion of assets, went out of that supervision. So I'm just using that as an illustration. I'm not trying to say that it should be 250 or 50, but the point is, I think the lesson we have learned from global financial crisis is valid, and these are the two lessons. One is one has to be very, very careful about defining the systemically important and kind of bring in psychology now. You know, how contagion is likely to spread, and we need a lot more studies on that. And secondly, at some point, there has to be a lender of last resort who you know, in domestic area we have it, but is it even possible? IMF obviously thought it could be, but the structure of IMF doesn't allow that to happen. So I think that's going to be a long struggle, but I guess it provides another opportunity to think of all those issues and any new learnings we've had. And I appreciate that Professor Persaud has you know, tried to put another perspective on it. I think it's very useful. In that sense, I think the diversity issue is very important because this is not something which has a simple solution. And I think even in terms of discussion, I think it's useful to have all the different perspectives. So with that, let me invite our second speaker, I think is Mr. Saran. Mr. Saran.
Mr. Saran, you will have to unmute yourself. Sir, kindly unmute yourself.
Yeah.
Yeah.
Yeah, no, I'm so sorry that I didn't unmute myself. Thank you very much for inviting me for this webinar. And I am not a little overawed by the eminence of my co-panelists and the chairman. No, and whatever remarks I'm going to make are with a full sense of humility. The first point which I'll try to make is this, that the Basel norms are an exception in the history of regulation. They brought in a certain amount of theoretical rigor in a field which was a practitioner's field. The three versions of Basel, or three editions of Basel, all three of them they jumped from one major concept to another major concept. So in the first Basel one, now the idea was universalism. The original set of banks was smaller, and only credit risk was provided, and a uniform formula was given. No, but somehow the simplicity of the Basel I regime was so seductive that it became the norm all over the world for all the banks in a very short time. The lack of diversity was felt, and the Basel II, that came and that gave choices and to both to the jurisdictions, various jurisdictions, and to the institutions. So you could adopt various approaches. You could measure your own risk So there was a certain amount of the concept of diversity, in my humble opinion, was really brought in by the Basel II regime. Basel III was again a major leap that it jumped from microprudential to macroprudential. Now, the search for stability is a never-ending search. Now, we are in so-called Basel IV, which I think only an extension of Basel III. But I think we must continue our search for stability and the newer concepts. In this context, the first point I like to make is this, that we have been looking in regulation at the regulator's action. We have not been looking very particularly at the architecture of the financial institutions or the banks. The structure of the banks has changed dramatically over the last 70 years or so, or maybe 50 years or so. Basically, the banking was a bank was a conglomerate of branches, and each branch used to be a profit center, and each branch used to prepare its balance sheet. They had their depositors, they had their loan book, they knew their customers. So, but when I joined the banking in 1976, at that point of time, the entire situation was manual. And I know it even in a bank in which only 350 branches was there, the inter-branch reconciliation was a nightmare. So it was kind of a necessity that the things were disaggregated and they were put into separate silos. So the credit was specialized into the head office or the credit people, and the credit, when especially later as it happened that the credit was was automated, and there were algorithms deciding whether somebody will be given a credit or not. So all that thing, what it did was to introduce economies of scale and made the administration of bank possible, but at the same time it increased the risk. For example, we give lower risk to retail portfolio for the reason we think that this portfolio is extremely diverse and the chances of everybody failing at the same time are extremely low. So that is why we assign very low risk weights to it. But in case of supposing the way the present lending happens, especially small ticket lending, it is an algorithmic lending. If there is a mistake in writing of the algorithm, or the environment changes, so there is no reason to give a smaller risk weight to the retail portfolio. Retail portfolio actually becomes pretty risky because there is some diversification in corporate loans, but the large retail loan becomes a kind of a one very big entity. So this tight coupling, so there is a tight coupling in the institution. So this tight coupling has resulted in more risk. And on the side of the regulator, what happened was that it was when we began in RBI used to inspect branches as well as head office, and something like 30% of the assets which were inspected were in the branches. But all that changed, and later it was either offline or it was even if it was offsite. I mean, it was online or it was offsite. Even then, on-site also it was only head office. So that was so a thing that even the regulator found it convenient to adopt this model. Now, the issue is this, that where what concept we can bring in diversification. I think there is a newer concept which is developing these days, is that of hyper localization. Now, in the normal uh, things, so it is known as, in the normal commerce, known as a mass customization. So there was a time when the suits were tailor stitched, then they were stitched according to broad sizes and then sold en masse. And then now a trend has come for mass customization, that you can enter into an app, give your things, and your suit is tailored to your things. It is possible because technology allows you to do it. So can we think of a model in which the diversity is built in into the financial institution itself? For, so, for example, the can we create a bank in which a bank is not one big monolith? It is something like a collection of a large number of economic units which interact with each other. And since the communication technology is much better than what it was 50 years back, it is possible to maintain the interaction between the units. And these economic units can be very different from each other, but all of them should have one element common, is this that they should be able to survive of their own. They should be in some way independent economic units. So a large bank should be a conglomeration of a large number of smaller units. Uh, the present day technology will even allow the central bank to regulate this from the technology point of view, that they can still understand the working of each economic unit. This this hyper localization is coming in other areas. I mean, not in exact simile, but we have moved from netting in settlement. It was economically more efficient. It was more efficient use of capital. But what we did was to move to RTGS. So because it reduced the risk, and the settlement was localized into one fellow sending the money, other fellow receiving the money. So similarly, in other fields, it is possible. For example, in securities markets, it is being talked about that with the blockchain technology coming in, it is very well possible to dematerialize a security into one smart contract, and that smart contract is on the blockchain, and this can be traded among two people. The settlement can happen through the smart contract within the blockchain. No, and so you don't need a separate clearing corporation. You don't need the huge monolith of a stock exchange, which have got a risk of failure as a whole. So the concept of hyperlocalization is also being toyed with and being studied in securities markets. So I think it is one idea that to see that whether the next step in our regulation of banks could be to study the concept of hyper localization in banking system. Thank you so much.
I'm trying to unmute. It's not happening.
We can hear you. We can hear you. We can
I'm
hear you.
trying to unmute.
Yes, we can hear
Okay.
you.
Yeah, it's come. Okay. Interesting idea. it reminded of us, long time ago, they had this kind of concept of distributed data processing. Somehow it reminded me of that. But yeah, I think a good, nice analogy, Mr. Saran, and probably worth thinking about in more depth. I just wanted to add one small thing that was, the in regulation, and not just banking. I think one of the things we struggle with constantly is the balance between reducing systemic risk and stifling innovation. That's really the kind of the third thing, which I mentioned two things earlier, and I didn't mention this, but this comes up everywhere. Wherever regulation is required because of some sort of externality or public good type of argument, there is this struggle to offset or balance risk reduction, systemic risk reduction with innovation. So that's another issue perhaps one will come back to. But let me now turn to Mr. Sinha. I don't see his face, but I don't. It must be here somewhere. Mr. Sinha?
Mr. Anand Sinha is connected.
Yeah. Can you hear me?
Yes, we can
Yes.
hear you. Would
Yeah.
you like to on your video, sir?
Yes, I'm doing that, but
Yeah, sure.
the internet connection is somewhat unstable, so that's why I had. And in case there is trouble in between, I'll switch off the video. Okay. So we are talking about diversity versus universality. In principle, in theory, there is absolutely no debate on the fact that diversity is most welcome. And if we can really achieve diversity, uh, it will help in containing systemic risk. Now, if we are looking at diversity, it will have two components. One will be the diversity of the business models of the financial institutions. And I'm talking in a wider context, not only banks, but also non-banks. And the second would be the diversity in regulations in different sectors, whether it is banking or asset management or whatever. Now, before I go further, let me give a disclaimer that I have been involved as RBI representative in formulation of Basel III, which is accused of promoting non-diversity. So with that, let me expound on the theme. Now, diversity in regulation, let's say diversity in regulation within the banking sector. I really, frankly, I don't understand how you can have diversity in regulations when you are regulating a set of financial institutions which have the same characteristic. Diversity in business models, yes, very much. And even today, there is diversity. There is no doubt that there are clusters of similar business models. For example, the largest banks, they all look similar as far as their business models are concerned. If you look at India, after the experience of large NPAs, you will find that all banks are becoming retail-oriented banks. And therefore, you have a concentration of retail lending across the system. Now, when you have this kind of concentration, then obviously you become vulnerable to systemic risk. Now, systemic risk, if we look at, systemic risk is basically an internal dynamics within the financial system or within the economic system. It is endogenous risk, it's not exogenous. The outside stress on the system, it could be positive, it could be negative. That leads to a kind of dynamics within the system where everybody acts in the same manner. That is, whether it is banks, or whether it is the corporates, or whether it is the households. So in the phase when the economy is doing well, you see all of them acting in a similar way. And when we go down in a bad phase, again you find everybody behaving in the same way. Now, as far as corporates and households are concerned, they don't have the kind of risk models, the uniformity of risk models which banks have. And yet they operate in a similar manner. So this is basically a psychological condition which leads to herding. Now, the point is that it can be felt that the risks are low. It can be felt that the risks are very high, irrespective of whether you have a model or not. So to that extent, it is difficult really to contain systemic risk. Now, let's look at the asset management industry. Banks we have talked about. Let's look at the asset management industry. In the asset management industry, for example, in the wake of COVID-19, there was a dash for cash. And who generated it? Not the AMCs. AMCs followed what the investors wanted. So it were the investors who acted in a way which was pro-cyclical, which had a negative view of the economic conditions. And they forced the AMCs to act in a particular way, and that generated a lot of systemic risk. Now, how can you contain this systemic risk? You need, let me say, a buyer of last resort. That means in a downturn, when the asset values are going down, it leads to a set of horrendous mechanisms in the system. For example, when the asset values are down, then there is the first mover advantage, because of which the investors rush to redeem their units. When they try to do that, then there have to be fire sales of assets. When there are fire sales of assets, then the value goes down. Then the others also, not only the AMCs, but also the banks or other entities which are holding the same or similar kind of assets, they also have to get into the act. They also have to sell their assets. So basically, the problem is of liquidity, whether you are looking at the banking system or whether you are looking at the non-banking system. So when there are spikes in liquidity, there is not enough providers of liquidity. We used to have market makers, but even market makers don't really have not really come off very well, and in particular after Basel III, when the regulations have become much tighter, the market making activity has receded somewhat. On the flip side, because of very low interest rates till recently, the debt has burgeoned. So you have a large amount of debt instruments. You don't have people who can provide support, liquidity support, when there is a spike in liquidity demand. So in how it has been contained, we have seen it's the government ultimately. In the case of Silicon Valley Bank also, you can see it's the Fed which is a kind of buyer of last resort. And therefore, I feel that it's very, very hard to contain. No doubt we should make all efforts to evolve our regulations if we can in a direction that this kind of systemic risk can be contained as far as possible. But no matter what we try, no matter how much we wish that it should be the market which should solve the problem for itself with the help of regulation and with the help of self-regulation, ultimately the last line of defense lies with the government. Now, if we are talking about the diversity in business models, let's look at Silicon Valley Bank. It's not a normal business model. You had a huge amount of non-insured deposits. You had a very rapid rise in deposits. Most of it, or a large part of it, could not be deployed into lending, even though SVG was very startup friendly. So they had a large amount of investment in government securities. Now, because the interest rates became very high, obviously there was a dip in the value. So a question arises whether HTM, unconstrained HTM portfolio, is it something which is desirable? Now, there is a counter argument that a mark-to-market based regulation breeds a lot of instability or a lot of volatility in balance sheets, which is very much right. But the point is that you are sitting on a portfolio whose market value is very little compared to the face value. And in the normal course, even if Fed would have given them liquidity against those holdings, they would have had to suffer the loss, because now, of course, Fed has come with a scheme where they are buying it at par. But in an one-off incident, most probably they wouldn't have done it. So the question is that while we try to promote diversity, diversity by itself is not really going to solve the problem, in my view. You have to also simultaneously look at the risks very carefully. For example, in the case of Silicon Valley Bank, somebody should have looked at the fact that interest rates have gone high and there is likely to be a liquidity crunch, because in this kind of situation, people need liquidity. Raising liquidity from the market is going to be very difficult or very costly. So you would want to withdraw what you own. And then this kind of situation happens. Therefore, what I would say is that we should explore the ways by which we can have, other than government or other than central banks, entities which are prepared to act as buyers of last resort of assets which have gone down in value. That is something which can, to a certain extent, contain the systemic risk. The other aspect could be, you see, the entire approach of Basel regulations is to build up resilience. And that's why you have more capital. That's why you have, for example, for G6, globally systemically important banks, you have additional capital buffer. So similarly, there could be a possibility of designing an index where you measure banks' diversity index with reference to some model. And then those which are whose diversity is low, you can put an additional capital burden on them. It will serve two purposes. In case they get into difficulty, they will have capital to absorb losses. And the second one is, which is how the GSIB capital buffer is also supposed to operate, that they will have an incentive to diversify. So, let me sum up by saying that diversity is very welcome, very desirable, not only in the financial institutions, but also in the case of regulators. So diversity is very welcome, but how to put it into action is a challenge, and it should be an area of research, further investigation, and we should certainly do whatever we can. But there is no substitute for managing individual entities' risks, as we have seen, for example, in the case of SVG, or so many other examples are there. So there has to be a combination of promotion of diversity as well as better risk management of individual institutions. So I'll stop over here.
Okay. I'm just going to start my computer.
We can hear you, sir. And
yeah,
just wanted to
let me
mention
just,
that Miss Neha has an emergency at home, so she can't join today.
Oh,
She'll bring in the climate finance, which is our topic for the next week.
okay. Okay, then you're going to questions, or what?
Sir, after your
I'm just starting
observations,
my.
yes, sir,
Huh?
after your observations, we can open to question answers unless members want to discuss one more round amongst themselves. I leave it to you, sir. We are ready with
Yeah,
some question answers.
I'm in the process of starting my computer, my home computer. So either I can continue on this. Let's see if. Okay, I think he's trying. Try करिए. Okay, so yeah, so what as SVB has been mentioned, I would like to say a little bit about that. I was talking to somebody who has just done a BA in economics, okay, and about this issue, and he said even he understands that if interest rates go up, the value of a portfolio will go down, right? So the puzzling, I mean, the puzzling thing is, I mean, this is that it doesn't require, high-level monetary economics or a central bank to kind of figure that out. So the issue really, I'm sure we don't know the full thing yet, but we will find out at some point whether the SVB deliberately ignored it. It could make profit out of it, or were ignorant, which is hard to believe. But if they were ignorant, they really needed supervision. I mean, in that case, the question arises that we perhaps overestimate the. Okay, here. Okay. So, overestimate the ability ability of the private sector to do these things which are even basic. I mean, it's really would be question all the assumptions of the people. I would call them the extreme ultra capitalists, I call them, who thinks that markets always know better, they can always adjust, etc. So one issue which needs to be investigated very carefully is that did they know and deliberately ignore because they thought they could get away with it, get away because the public was stupid, or because no regulator was doing oversight. So I think in this particular case, it's not a very complicated issue actually, and it is a puzzle which will have to be investigated. But as I said earlier, it does give us another chance, us meaning the different countries, the international development banks, regulators, etc., to have another look at this issue, which everybody thought we had sorted it out after the 2008 banking crisis. So, with those kind of brief observations, let me turn it over. Charan, you also have done a lot on this. You want to make your observations, or how do you want to play it?
Sir, I totally agree with the discussion that has taken place and the diversity of thought that we have seen on the table today. On one hand, we had Avinash Persaud, with whom I totally identify. And as he rightly mentioned, that is exactly where when we started interacting. And
Sorry, I can't hear you, Charan. Oh, maybe my system is not working. Okay. I'll take care of it. Okay.
Can you hear me now? Hello, sir. Can you hear me now?
Yeah, Charan, you are otherwise audible.
Audible? Okay.
Yes. We are.
I'll wait for the chairman for a minute if his system starts working. Whereas we can hear him clearly. So the point that I'm making, I don't know if Mr. Avinash Persaud is still there. The point I was trying to make is that diversity has to be taken into account and plays a very prominent role in the matching of the liquidity requirements as well as surplus and the deficits. And the system matches it automatically on its own. While Mr. Prashant Saran did mention that we are in Basel IV, and to some extent, diversity is being considered. Mr. Anand Sinha also mentioned that yes, there could be a diversity index. My own view has been that banks, which, like many banks in India, which have been here for more than 100 years, and they have survived through different, very different circumstances. And if they have been here for more than 100 years, they've seen the partition of the country, they've seen the nationalization of the country, they've seen the rise and development and flourishing of many new banks. They've accommodated foreign banks in the country, they've still survived. And some of them do not even have a foreign branch. And if you impose Basel conditions on them, is that not very expensive on the bank itself? That's one thing. Secondly, the issue is the local conditions of banks could be so different that Basel norms could be stifling and not required at all, or Basel norms gives you an artificial sense of safety because saying you've come up to the quantitative figures, but the fact is underlying it, there was a very weak, vulnerable system. And that's exactly what happened under the cover of Basel norms. All the banks looked very good. The stress testing that was done around COVID in many European banks. And now, when it has just happened that 3 banks went under without anybody even getting to know about it. So, was it that the Basel norms were giving us a false sense of safety where that should not have been, and suddenly we get a big hit? And 2008, well, we can say now that the Silicon Valley, the Signature Bank, and the Silvergate, they were different. But please, in 2007-8, when we were facing the 2008 Lehman movement, UBS again was hit. And this time, of course, we know Credit Suisse is getting hit. So my thoughts are, do we need to rethink our Basel norms, reload and reload the norms, revisit the whole issue? And I think on the platform of G20, where we are discussing today, where we have international audiences with us, we need to flag that there needs to be a more nuanced approach to safety of banks. Thanks, sir. I think Mr. Arvind Virmani seems to have just logged out. Yeah, there he is.
Okay. Yeah, okay. Yeah, so I see Oshima there. Oshima, do you want to, Dr. Goyal, do you want to make some comment?
Sure. Hello, everyone. Hello, Mr. Sinha. Long time. We used to be together on a board.
Yeah.
So I had a couple of questions or comments. One is that this apparently SVB lobbied for relaxation of capital adequacy or liquidity norms because they said they're a small bank, and the Trump administration gave it. So in that sense, and they did not have a risk officer for 7 months. So this was a regulatory failure. It seems that you do need diversity in regulation, in the sense you need supervision, you need liquidity norms. But I agree with Charan that very often, for example, in India, we have something called exposure limits, especially after that large corporate lending, that you're not supposed to be, there should be diversity in your loan book also. So SVB did not have that because it was a sectoral bank. So then on the diversity index, they should have much more held much more liquidity, etc. So I think that and just capital becomes inefficient way of regulating, in the sense an expensive way where capital is scarce. So if you can have other things like exposure limits, or also counter-cyclical regulation, because this issue of liquidity spikes and everybody wants liquidity at the same time. If you decrease the regulatory imposition on liquidity and allow more to be released into the market, So counter-cyclical regulations also another way which could bring diversity in regulations and help moderate these kind of cycles. So this is a question to Anand, and to, I don't know if Avinash is still there, but this issue of foreign exchange currency risk being really important for the cost of borrowing for emerging markets, and what can be done about it. We know that hedging is very expensive, and it's for 6 months or 1 year, and it's, while the kind of currency risk that affects the cost of borrowing is more that there is a small possibility of an event occurring, such as a political change or something, which can lead to a large spike in the currency or depreciation of the currency or some kind of capital market aberration. Many of this now is coming from foreign risks due to global risk on, risk off. So it's not the fault of the country at all. And many emerging markets have really made their systems more robust. So, but what is the kind of hedging that can be designed for this? It needs to be some kind of insurance contract. Is there any thinking on this? That was my question. Yeah, thank you.
Right. Yeah. Interesting questions raised. I mean, there are many different ways of looking at it, but one way you could think of it, having followed this, and again, I don't mean it as a criticism, we have to kind of think of all these possibilities, that some of us thought the Fed acted too slowly, over the last several years when fiscal deficits were being pushed up through fiscal policy. Actually, it reminds me of our own situation in 2010 after I left, where fiscal stimulus remained high even after we had met the global financial crisis, and then suddenly we started clamping down on the monetary side. It's kind of partly exogenous risk, partly endogenous. Exogenous because of the pandemic and the Ukraine invasion. If that had not happened, the Fed could probably argue, oh, it would have all worked out smoothly. But then it's endogenous because of the Fed's reaction to these things. So it's a very complex issue. But point is that ultimately, when they did act and the interest rate went up, what is a puzzle, and I invite anybody to answer this, I mean, it's not very complicated economics for SVB to have figured out, whatever their model was, whatever, that they are going to have a huge capital loss, and they are having it. And didn't their risk manager kind of think about this, do anything about it, say anything about it? Now, there is a hint. Now, again, I don't want to accuse anybody of anything, but there was a report which said that 3 members of the management team sold stock maybe the month before it went into a complication, and one of them sold 1 million worth of its stock. So, so anyway, so what I'm saying is that this issue is new. I mean, this is not, until we resolve this issue, this is not really telling us more general things. So we have to be a little careful from overgeneralizing on these things. But yes, all the issues which you have raised, which the others have raised, have to be rethought, obviously. So you asked open Mr. Sinha and others if they want to react to the question, please react.
Yeah, I would. I think she directed her questions to me, so let me reply. You see, obviously the internal management and the regulatory oversight both did not spot or could not spot or ignore whatever was happening. Now, if you look at the internal aspect, the fact that financing conditions had become difficult because of high rates of interest on account of inflation, that should have alerted the internal management of the fact that there will be withdrawal of deposits. There will be a demand on deposits, and therefore how are they going to meet the requirements, considering the fact that they have a huge not mark-to-market portfolio? As far as the regulatory aspect is concerned, there were quite a telltale signs, no doubt. Number one, the deposits had grown enormously in 1 year or 2 years. Then there is a large not mark-to-market portfolio, of course, sanctioned by regulation and accounting standards both. And it is in that context I said whether it is a good idea to allow HTM portfolio unhindered, because HTM portfolio assumes that you are not going to have to sell it, but then you have to plan for situations where you may have to sell it. The third thing is that because of heavy lobbying in US, the Dodd-Frank Act was diluted considerably in 2018. And this is not such a small bank. This is 16th largest bank in US. And had it been under Dodd-Frank, it would have been subjected to severe stress tests. And maybe it would have thrown up the red signals. Maybe, I mean, we don't know what exactly would have happened, but maybe the regulatory or the supervisory system might have been able to alert itself and alert the bank for necessary actions.
Example where a bank was lobbying for weaker regulation. You have very strong corporate lobbies in the US.
Yeah, yeah. In fact, the
uniform regulation, you should not give in to those lobbies, and those lobbies are based on
the entire dilution of Dodd-Frank was because of lobbying only, in which this bank also took a
yes. They were small then, but they grew in the meantime because huge startups were putting all their giving them all their money. So they became large, but they continued with weak regulation. But what about this thing about counter-cyclical prudential regulations? That you reduce the demand for liquidity?
No, counter-cyclical regulations when we talk about, for example, if we talk in terms of capital, then it has two objectives. One objective is to build up resilience. That means to enable the banks to have more capital, even in good times, so that when bad times come, then you are able to release that capital to absorb losses and to continue to lend. That is one. The second most or very desirable requirement would have been to moderate the credit cycle so that you can contain the buildup of systemic risk. But all the evidence points to the fact that the second aspect does not really happen. That means the credit cycle does not really get significantly moderated because of the higher capital requirement, the counter-cyclical capital requirement. Therefore, what we are left with is pools of liquidity and pools of capital to be able to be used during a downturn. But there are very many reasons why it doesn't happen. Number one, during a downturn, the corporates and households are equally wary of borrowing. So it's not only banks which are shy of lending, the demand also is not much. That is one aspect. So this is a mechanism. How to get over it is a difficult question. And that is where government's role comes into the picture. So
ultimately, lender of last resort is
ultimately, it seems to me that no matter how much we want to keep taxpayers' money out of all this, perhaps in a severe crisis, there is no alternative.
This issue of, repaying the depositors, but penalizing the shareholders, that's very important.
Yeah.
They must not be rescued.
So what I have read is that in the case of SVG, shareholders and bondholders are not going to be protected.
Okay, thank you.
So somebody bears the cost.
Yes.
And the market has borne the cost very heavily.
Yes.
So taxpayers eventually did pay the cost.
Yes, you look at Fed. Fed is buying a loss of 1.8 billion on its balance sheet because it is buying those bonds at par, whereas the market value is less by 1.8 billions. So that is a cost which is being borne by the public sector.
Yeah. And sir, the question that Dr. Virmani, our chairman, mentioned that a graduate in economics knew it, but you know, I look at India and we've seen how a deputy collector works. A river, little flood, he knows which are the vulnerable areas and quickly puts the sandbags there and takes care of it. It is amazing that the interest rates were rising at that rapid rate, and nobody thought that there could be balance sheets which would be exposed to the interest rate risk and take the system down. That's amazing.
In US banking system, there is a 620 billion US dollar interest rate risk sitting on the bank books in the whole system.
So, Charan, actually, I kind of disagree on one point. The whole concept of lender of last resort doesn't require the lender of last resort to do short-term mark-to-market. That's completely contrary to this whole point about counter-cyclical policy. Government policy, if we say has to be counter-cyclical, then actually it's a long-term expected loss or gain which they should be looking at. If you are looking at the whole system over the long term, as a government or its agent, a central bank must do, they can't base their expected loss estimate on short term, you know, while a private small entity has to do it because that's part of the regulatory structure. So, you know, I say this because many right-wing people in the US are flouting this thing that, oh, the government by intervening has lost so much money. No, they've not lost it. They have to do an expected return over, you know, whatever, 3 years, 5 years, whatever period you think is reasonable. It's not the market loss today that the central bank or the central government will be looking at. It should not be. I think that's no point of having a lender of last resort if they are also short-term oriented like the private sector. So, so that is one point.
What's it?
The other one, which I think it's too early to say, but you know, if I mean the point that it's not satisfactorily answered, maybe we have to speculate that such a simple thing everybody can see that in mark-to-market terms, you know, they know what the HTM portfolio, whatever it is, that your equity value has gone down. The question is, it should have been happening continuously, no? I mean, it's not very difficult to figure out, right? Was it hidden? Isn't it in their accounts how much portfolio they hold? Cannot anybody in the public and institution or anybody calculate, not to even mention their management, who can't calculate what is their equity value today after interest rates have bumped up so much, which is a separate issue from what happens to depositors. Let's say all the depositors have remained there, and the equity value goes to zero or negative. Should not somebody have been reacting to that?
Certainly.
Mr. Want to take that up?
No.
Sir? Sir?
Anybody else?
No, you are asking me.
Anybody, if you want to take it up.
Yeah, sir.
Yeah. First question about, I mean, your first remark that if the Fed has intervened or if the government has intervened, it should not be seen as taking a loss. I entirely agree, because at the same time, the central banks do not really want to wade into losses, and that is why you have the transactions at market value. But when we judge the action from a longer term perspective, we have to weigh the cost, the accounting loss, if at all it finally results into accounting loss, vis-a-vis the loss which would have happened to the economy. So, so as far as the public sector is concerned, the accounting loss should not be and is not an issue. As far as the second thing is concerned, you are absolutely right. That's what I have been saying, that it should have been noticed. But what has happened is it does not reflect in accounting, because in a held to maturity portfolio, we are not required to mark it down to market. So notionally, you know, but it does not reflect into your balance sheet.
Thank you, sir.
So,
Thank you, sir.
I don't know whether Ashok, Dr. Vishandas, you want to ask any question?
Sir, I have doubt,
Sir,
sir.
thank you, Chairman, sir. And it was a
Okay, I'll come
lovely.
to you.
Yes, may I ask?
Yeah, you go ahead
Yeah.
first, then I'll take up the person. Yeah, I think Ravi.
Yeah. Thank you, Chairman, and all the panelists.
Thank
It
you,
was a
sir.
very lively discussion. My two small observation and a question is, Anand Sinha said that neither the shareholder nor the bondholder are protected. I can understand shareholder if shareholders are not protected because they are in some sense owner and therefore they have to share the loss and profit both. So that is understandable. But how come bondholders are not protected? Because that is at least expected of them. That is question one. Second, we have seen how Lehman Brothers collapse, how SVD Bank. So what our central bank in India, how and what kind of firewall they must construct so to protect our banking system in India from such recurrence?
Okay. Why bondholders have to sacrifice? The answer to that is that under Basel III regulations, the bondholders who are holding bank capital in the form of these bonds, there is a requirement that in case a bank becomes insolvent, or if the capital level dips below a
Sir, I
certain
have
level,
doubt, sir.
then the bondholders stand to lose. So it's a part of contract. And you see, that is what happened in the case of Yes Bank in India. Now, of course, I don't have the details of what kind of bonds were there, but if they were compliant with Basel III, then the capital bonds would have been of this nature. The second nature, the second aspect could be that in a resolution or liquidation, you have a hierarchy of claims. So their deposits will rank higher than others. In which case, if after satisfying depositors, anything remains, then it will go to the bondholders. Possibly that could be another reason.
Yeah.
And what about my second question? What kind of firewall our central bank has to construct or build?
Firewall, well, this is a globalized economy, so you can't really isolate the Indian banking system from outside. The answer is much better regulation and even more, much better supervision. Not only by the central bank, but by the banks themselves, because central bank cannot take care of each and everything. After all, it's limited. They have limited time, limited resources. In any case, the first line of defense has to be the bank itself. So there have been a lot of improvements, and these are being reflected now in the metrics. For example, the NPA, which was such a big problem, now it has come down considerably. The system NPA is down from more than 10%, now down to 5%. It is expected to come down. So it has to be a combination of strong regulation and even stronger supervision.
Sir, I have doubt, sir.
Charan, who is it? I can't. Somebody is talking.
Mr. Prabhakar. Mr. Prabhakar.
Okay. Yeah, you've been here from the beginning. Go ahead.
Mr. Prabhakar, please go ahead, but be brief.
Go ahead, Prabhakaran.
Sir.
Yeah, go ahead. You want to say something? Can't hear you.
Sir, I have doubt, sir. In a central banks is also replacing with firms in all banks also.
No, I couldn't get it.
Okay, let us take some Charan. I think we should take 1 or 2 questions from the chat box. Do you see
Sir,
anything
yeah,
interesting?
there are interesting questions sir in the chat box. But sir, I had one quick question. Maybe Mr. Prashant Saran can answer that. That one of the reasons why the market listing is done is that the market also plays a corrective force or a coercive force on the management to correct the course of action. Now, these listed entities that they are, they should probably learn from the market reaction. How come that didn't happen in the case of all these banks that are going under since 2008? Means, is there something wrong in the Basel norms in expecting the market pressure to be coming in?
No, actually, market pressure should be a guiding beacon. Now, because it is understood that if nobody else was looking at the bank and its risks, the research analysts should have been looking at that. And the research reports, I have not done any much work on SVB, but I think it is a failure of the research analysts also that they didn't bring out this risk. And there is one thing. The second thing where market failed was that either there are no proper disclosure norms. If a large shareholder and who is in management is selling such a large amount of shares, at least in India, I think this would have been picked up by the surveillance systems in the securities market. And this should have given a signal to the other investors that what is happening, that why the management is selling. And I don't know whether in India there are this kind of a large selling would have resulted in prevention of insider trading regulation. The disclosures would have caught that. So, but here they sold 1 million shares, and even then it was not picked up by the markets. That I am really surprised. Both of these things happened. Market should have been a beacon.
Thank you, Mr. Saran. That's exactly, that needed to be said. You said it.
There are two questions in the chat box which are very interesting.
Yeah,
if you permit. Yeah, so one is, and the one question I find it interesting because we'll need to tap your, as an economist cap. So the one question, sir, is should bank avoid derivatives to avoid interest rate and market risk? That is from Mr. Suresh. And the other question is, in just a second, that's a very interesting question. I thought we'll have your thoughts also on it. How would the Fed handle this situation now, given that they have to save the banks as well as continue with inflation targeting?
Yeah, I think the first one perhaps Mr. Sinha or Saran can handle. Yeah, as far as the Fed is concerned, it's I think Mr. Saran has made clear in the US system, Fed already has a lot of stuff on its hands, so government will back it actually. The actions, the Treasury will ensure now that the future risk is handled. That is my judgment, just my understanding of the political structure and the where the president is today, etc., etc. So that's just my guess, you want to call it, or my judgment. But let me hand it to Mr. Sinha that on derivatives, etc. I'm sure you've dealt with this issue many times. I can't hear. Charan, can you hear?
No, I think Mr. Sinha or Mr. Prashant Saran, I can't hear any one of them.
No, no, I was on mute.
I will take that question on derivatives.
Take it.
Okay. My view is this, that banks failing used to happen much before derivatives. That is first thing. I mean, derivatives are not the major cause or are not the trigger of bank failures. Bank used to fail for various reasons. So that is one thing. Second thing is this that derivatives are only basically messengers. They, I mean, you should not shoot the messenger. And the crisis, the global financial crisis, which happened, was because of the incorrect valuation of derivatives. So the issue is this, that if you are not able to, if the derivatives are too complex, so the problem occurs. It doesn't happen if you are using the exchange traded derivatives, but when it comes to interbank dealings, the OTC derivatives, the OTC derivatives become so complicated and many a time, which that they are almost impossible to value. Neither the buyer knows what is the value of this derivative, nor the seller knows. So so that there needs to be some kind of a strictness on this issue, that if you can't value and can't value it well, you should not have that derivative on your books. So that is basically a supervisory and a regulatory function. Now, I mean, this actual issue which we faced somewhere in the year 2010, that there was a lot of forex derivatives in Indian banks' books, so which were kind of the banks were, many of them were almost going to go down under, but by some stroke of luck it was reverted, and then the RBI introduced much more strict norms on buying and selling of derivatives. So there is always a problem when the regulator acts on these things strictly, then the question comes, then the accusation is that of stifling regulations, so which are not allowing banks to function or the financial institution to function. So derivatives is a very complex topic. Not single answer is possible.
Good, very good answer. Just to kind of translate it for some people, basically the problem with the OTC, the thing which triggered the global financial crisis was packaging and repackaging. If you want to imagine it, what comes to my mind is these, the magician has this glass with a coin under it, and he keeps flipping it around. That's kind of what the OTC derivatives which caused the problem were. They were packaged, repackaged, combined with A, combined with C, and presented at B plus and A. And then finally, nobody knew what exactly its real risk rating was. And then there were allegations of mis-selling, that the seller actually knew what exactly they were doing, but the poor buyers didn't. So there was a lot of to put it very politely, non-transparency. Yes. Thank you, Mr. Saran. I think you put it quite well.
Dr. Virmani, there was another villain of the piece, which was Gaussian distribution.
Yeah.
So,
right.
So all the models were Gaussian.
Right. Okay. So, Charan, one last question. I think we are already over our time, or should we conclude?
I thought Mr. Anand Sinha wanted to say something.
He did? I thought he did.
Hello.
Okay.
The last question.
Okay.
Good evening to everyone. So a lot of banks, as per the RBI survey recently, since climate change has not happened, not while giving their loan, they are not making environmental assessment, and most of the loans are right now banking sector is facing crisis from the not counting the environmental concern in their loan disbursement. So I would like your take, because ESG reporting is not right now. It's just the beginning of these concepts in the recent years.
I think as far as ESG reporting is concerned, SEBI has come out with some requirement for top 100 companies or some such number to come out with disclosure. I think Prashant can speak better on that. RBI is in the process of coming out with guidelines on dealing with, even the international organizations are in the process of, or have just come out with guidelines on how to deal with the risk part of arising on account of climate changes. So it's something which is in a very nascent stage now, and dealing with that or modeling or projecting the kind of risks that will come is difficult. It's not easy because of the fact that the data, there is not enough data, and not only that, the past cannot be a predictor of future. And in climate changes, there are many inversion points, tipping points, as you say. So all these are difficult, but the regulation is and the methodology to deal with that is in the making. So down the line, it will have the same kind of rules and requirements as you have for other exposures.
Thank you. Okay, Charan, I think we've gone 5 minutes over. Should we conclude it?
Yeah,
Thank you to all the discussants and participants and the people who were listening. Over to you, Charan.
So, Mr. Prabhakar, you have been asking a question. Can you be focused and ask clearly?
Yeah, it's not clear.
What's the question?
Sir, in RBI centralized government is one of the middle centralized to all sector banks, sir, in private sector and public sector also, sir.
What's the question?
No, sir. In RBI bank is one of the centralized banks, sir. In a private sector also, they will prevention to the amount of, sir, in a partial amount to government or property, sir.
They did. Mr. Anand Sinha has been the DG, and so was Prashant Saran. I thought they did it on the Global Trust Bank and when other banks were in trouble. But sir, can we ask one of them to answer this?
Yes.
I'll let Prashant answer this.
Can you repeat the question? I really didn't understand it.
I think, sir, his question is that in case a private sector bank suffers losses, will the Reserve Bank, which is the central bank of our country, bail out a private sector bank? I think this is his question.
Actually, I mean, we don't bail out. I mean, we resolve the banking crisis. And the usual way in which RBI has been dealing with it is something known as compulsory merger. And what it does is to merge that bank into a large functioning bank. And then what they make them lose is the equity holders and the 81 bond holders, which are the capital bonds. So the depositors are protected in that way.
Yeah, so to put it...
That is how it resolves the private banking crisis.
Yeah, to explain it to the common person, you're not bailing out the bank owners. The owners lose their money completely. Equity and the bond holders, as Mr. Sinha explained earlier, who are the capital backers. You are saving the depositors, not the bank and the bank owners. So this thing about bailing out, you're not bailing out the private person. You're bailing out the private depositors. Yes. And some people in the US say that you should not even bail out the depositors because they should be smart enough to have figured all this out themselves. In India, we don't do that. We generally try to save the depositors. And of course, the exact limit, Mr. Saran and Mr. Sinha would know. But anyway, I think we have to conclude the session now. So as far as I'm concerned, we have concluded. And so, Charan, you want to just say anything?
Sure. Yes, sir. I want to thank each one of the participants. I want to thank you. I know you had a very busy day, but you still accommodated our request to chair the session. And sir, I want to thank the panelists. It was pretty early, for Avinash Persaud, and he got up and did that for us. And then he had to leave, of course, too early up there. And the two panelists who stood with us throughout, Mr. Anand Sinha and Mr. Prashant Saran, who have been with us and taking our questions. I want to thank each one of them for the webinar today and taking our questions and enlightening us on such an important issue. Our today's discussion will be available on internet tomorrow in the YouTube, and we'll share the link with all of you. We continue with our journey on the G20 Task Force T20 Task Force 5 next week, and next week we cover climate finance. Next 2 weeks are dedicated to climate finance, and we are going to have speakers from across the world. Professor Galina is joining us from University of California, Santa Cruz. She was earlier with the Fed Reserve San Francisco. She'll be joining us. And so we are going to have a very interesting discussion again next week. So I would invite you all, because she's joining us from San Francisco, the timing will be 8 to 9:30 p.m. next week to accommodate her. And then, of course, week after that, again, we are doing on climate finance. So 2 weeks are dedicated to climate finance. I would invite all of you to please come, join us, benefit, and also enrich the discussion. Once again, thanks to all of you, and see you all.
Nice to meet you, sir. Nice to meet you, sir. Anand Sinha, sir.
Thank you.